All right, welcome to the Explainer. Today, we're going to tackle something that can feel super complicated, India's corporate tax code. Whether you're a local startup or a big international player, we're going to break down exactly what you need to know.
So, you're thinking about doing business in India, or maybe you already are. The number one question on your mind is probably, what am I actually going to pay in taxes? Well, let's dive in and break it all down, starting right from the beginning.
Okay, first things first. What even is corporate tax? At its core, it's pretty simple. It's a direct tax that companies pay on their profits. So after you've paid for all your expenses, your materials, your salaries, everything, the government takes a slice of what's left over. And this isn't just for Indian companies. It applies to foreign firms earning money here too.
All right, Section 2, the core tax rates. This is the part everyone really wants to know. How much are we talking about?
Okay, and right off the bat, here is the first huge difference you have to get your head around. For domestic companies, the base rate is either 25 or 30%. But for foreign companies, that starting rate jumps all the way up to 40%. A pretty big gap, right?
Okay, so let's zoom in on domestic companies for a second, because it gets a little more detailed here. The rate you pay actually depends on your turnover, but this is where it gets interesting and where strategy really comes into play. You can actually choose a lower 22% rate, but the catch is you have to give up certain tax exemptions. And to really push that Make in India initiative, there's this super attractive 15% rate available for new manufacturing companies. That's a huge incentive.
So you take the base rate, you add on a surcharge, plus a 4% cess, and what's the final number? What do you actually pay? For most domestic companies, the effective tax rate, the real number, lands right around 25.17%. That's the number you really want to keep in mind.
All right, let's move on to domestic versus foreign companies, because the difference isn't just about that base rate we talked about. It's also about what income is actually getting taxed.
Now, this is an absolutely critical point for any business strategy. Take a look. An Indian company gets taxed on its global income. Doesn't matter where in the world it was earned. But a foreign company, they're only taxed on the income that's generated right here in India. That distinction changes everything.
Let me give you a perfect example of how this plays out in the real world. Imagine an Indian company needs to pay royalties to a foreign company. They can't just wire the full amount. Nope. First, they have to deduct a 10% tax right at the source. This is called TDS, or tax deducted at source. Then they can send the remaining amount. It's a clever way for India to make sure it gets its share of the tax on money that was earned within its borders.
Okay, Section 4. Let's get into the nitty-gritty, audits and filing rules. This is all about the practical side of staying compliant.
So when do you actually need a tax audit? Well, it all comes down to your turnover. For professionals, the threshold is 50 lakh rupees. For most other businesses, it's 1 crore. But check this out. The government really wants to encourage digital payments, so they've built in this massive incentive. If your cash transactions are less than 5% of your total, boom, your audit threshold jumps all the way to 10 crore rupees. That's a game changer.
All right, so it's filing time. Which form do you use? For the vast majority of companies, we're talking private and public limited companies, ITR 6 is going to be your go-to.
There is a big exception, though. If you're a charitable or religious trust and you're claiming tax exemptions, you've got a different form to deal with, ITR 7. And you know this, but deadlines are absolutely crucial. You got to mark your calendar. For most companies that need an audit, the big day is October 31st. But you might get a little breathing room. If your company has international transactions with related entities that need a special transfer pricing audit, you get an extra month, pushing your deadline to November 30th.
Okay, Section 5, special tax scenarios.
We've covered the main road, but now let's look at a couple of important detours you need to be aware of.
All right, let's talk about the government safety net, which is called the minimum alternate tax, or MAT. Think of it this way. It's designed to close a very specific loophole. You have some companies that report massive profits to their shareholders, but then they use a ton of deductions and exemptions to make their taxable income look tiny. Well, MAT steps in to make sure those companies still pay a minimum amount of tax.
And that minimum rate is set at 15%. Now, here's the really crucial part. This 15% isn't applied to that low taxable income figure. No, it's applied to the company's book profit, the number they actually show in their official accounting books. This guarantees a certain baseline tax gets paid, no matter what. And that brings us to our final section. Thinking about taxation as a business strategy. Because really, this is about so much more than just filling out forms and staying out of trouble.
I really want you to take this point home with you. Understanding all these rules isn't just about paying what you owe. It's about using this knowledge as a tool. It's about making smart decisions, like choosing which tax regime is best for you, or figuring out the smartest way to structure your international payments. These are choices that can actively boost your company's bottom line.
So, I'll leave you with this question. Is your tax plan just about compliance, just about checking the boxes? Or are you looking at this complex system as a strategic tool, something you can use to actually fuel your company's growth? It's a question every business leader in India really needs to ask themselves.